Hello friends, I Ritu will discuss certain concepts of economics with you. Today we will start with the calculation of national income. Friends, first of all you should know the difference between national income and domestic income. Domestic income is sum total of factor income generated within the domestic territory of the country either by the residents or non-residents of the country. And national income, this is something total of the factor income, that is reward for factors of production, that is compensation to the employees, rent for the land used and the building used, interest for the capital utilization, and the profit for the enterprise. In other words, we can say national income is a domestic income plus net factor income from abroad. There are three methods for measuring national income. Three different methods used are product method, that is also called value added method, income method, and expenditure method. First of all, we will go with the product method or say value added method. What is value added? Friends, notice in the table, here we have taken 4 columns and 4 rows. First of all, enterprise. Second column is value of the output. Third column is cost of intermediate goods. And the fourth column is value added. That is all we want to know about. And the rows we have included are, first of all, the flour farmer. Then comes the flour mill. Then comes the baker. And last we have taken is shopkeeper. And in last is the total. Friends, let us start with the farmer. Now we will discuss how value-added method will work. First of all, let us know about the intermediate goods. They are the goods inputs rather than factor inputs, that is raw materials used. Now here in the table we are discussing, starting from the farmer, intermediate goods of rupees 200, that is used in seeds, fertilizers and irrigation. So value added by the farmer is 600 minus 200, that is 400. Now, flour mill will buy the wheat from the farmer of rupees 600 and sell it at rupees 800. So, the value added by the flour mill is rupees 800 minus 600, that is rupees 200. Now, he will sell it to the baker and baker will buy for rupees 800 and sell the bread of rupees 1000 to the shopkeeper. Now, here the value added by the baker is 1000 minus 800, that is rupees 200. Further, he will buy a bread for rupees 1000 and sell it for rupees 1200 to the household. Thus, the value added by the shopkeeper is 1200 minus 1000, that is 200. Hence, thus the gross value added is rupees 400 plus 200 plus 200 and plus 200, that is rupees 1000 total. Friends, now here we will calculate measurement of national income by value added method. In left side, you see gross value added by all producing enterprises. They are primary sector, secondary sector, tertiary sector in the domestic territory of the country during an accounting year. This is all equal to the market value of final goods and services produced during an accounting year. Here you get gross domestic product at market price. Now we will reduce the depreciation out of gross domestic product at market price and we will get net domestic product at market price. And after we reduce net indirect taxes from net domestic product at market price, we will get net domestic product at factor cost. Here we will add net factor income from abroad to net domestic product at factor cost. We will get net national product at factor cost, that is our national income by value added method. Now we will calculate the measurement of national income by income method. It will include compensation of employees. Compensation of employees means the cash paid to the employees by the employer for the work done by the employees during an accounting year, and it will add to the operating surplus. Operating surplus, it is rent, interest or profit. But friends, be careful, we will not include dividend or corporate profit tax or undistributed profit into the operating surplus. And plus mixed income, it will give us net domestic product at factor cost. Now we will add net factor income from abroad, which will give us net national product at factor cost, which will include compensation of employees, operating surplus, mixed economy, net factor income from abroad, and here we get the national income by income method. Compensation of employees will include wages and salaries paid in cash by the employer to the employees, payment in kind like rent-free accommodation by the employer to employees. Social securities will include provident fund, retirement pensions, but be careful, old age pension is not included here. And profit will include rent, interest and profits, but it will not include dividends, corporate tax and undistributed profits. Mixed income will include income of self-employed person, that is person with his own land, labor, capital and enterprises. Now friends, here comes the measurement of national income by expenditure method, or we also say consumption and investment method. It is also called income disposal method. It will involve private final consumption expenditure, that is denoted with C, government final consumption expenditure denoted with G, investment expenditure denoted with I, and net exports, that is exports minus imports, that is our net exports. In measurement of national income by expenditure method, we add up the sum of private final consumption expenditure, which include consumer services, consumer durable goods like washing machine, consumer non-durable goods like milk and butter, government final consumption expenditure, that is government is purchasing consumer goods for defense, business fixed investment for manufacturing and buildings, government fixed investment for building of dams, investment on residential construction by households, inventory investment. Friend, inventory investment involves, it is a difference of closing stock and opening stock. Then comes net exports, that is total exports minus total imports, that is our net exports. Friends, be careful, business fixed investment, government fixed investment and investment on residential construction by households will give us gross domestic fixed investment.